bank collapses, the Fed pivot. It's not a Fed pivot, it's a Eurodollar futures pivot, but there is a pivot. We're going to talk about that. So this is Brian Lewis from MMT Investing, coming to you from Peru. I'm decked out in alpaca, and things just changed. So yeah, let's take a look. A quick look at Eurodollar futures. This is the chart that predicts what Fed funds is going to do. This is all of the international bankers and bond traders basically betting on inflation, not consumer price inflation, like real inflation. The amount of dollars being created or destroyed across Earth is this chart. Fed funds follows this chart. This is indicating about 5% Fed funds rate, and Fed is still behind that. Fed's like 4.5, I think, right now. They still have room for another hike, but this pivot is very important, and being at the top of the cycle is very important. I'll show how that correlates to the stock market. Roughly sideways is good, and up and down vertical is bad for the stock market. And so, yeah, let's take a look. Let's take a look at some indicators. I'll come back and explain the Eurodollar chart and what's actually going on right now. So the Eurodollar chart has been going roughly sideways at a high rate. And so usually that's going to be sideways-ish or a little bullish, but we have enough inflation that's pulled us down. And then we've been swinging slightly bullish here. So we're going to find out if this is a false breakout of the downtrend or if we're actually breaking out on the S&P. Let me flip through some indicators. TLT, treasuries. Treasuries are at support. False breakdown here, but this is very long-term support on treasuries, and we're getting a pretty big up move on treasuries right now. So that's important. People moving into treasuries matters a lot. I'll talk about that in a minute when I get to the banks. And high yield, this is corporate bonds. And so corporate bonds breaking out of a downtrend is usually very bullish, but you can see the breakout is usually strong and goes bullish. This is very volatile, and it's kind of breaking out, but it's still droopy. Not that great of an indicator. If you look at the junk bonds versus the treasuries here, you can see we're still in a very high risk area here, and we're making a down move. Not very decisive, but down moves in this indicate bad things for the stock market. Not super decisive right now. The Dixie, the DXY, this is the dollar index. What does the dollar look like versus other fiat currencies? And generally, when you're coming down, that means a lot of dollars are being created. And when you're going up, that means dollars are getting tighter. And so this recent little down move correlates with the little bull run we've had. And now we're at a support level and we're on this bull trend. And so we'll see if we go strong. It looks to me like this might go strong and not be very good for stocks, just as you cross back and forth across these channels. But there's been a general bull trend since 2008 for a long time, like 20 years on the DXY in general. It continues to get stronger against other currencies. But it's these short-term moves across channels that correlate with the stock market. And so, boom, we went strong. We've been bearish for a while here on the strong move. This down move was a little bullish, and it looks like we might go strong again. So that's slightly bearish. And this is a NASDAQ. So the NASDAQ looks like it's making a real breakout of this consolidation area, which is interesting. So we'll see how that develops. And if you look at the NASDAQ versus the S&P, you can see right now the NASDAQ's going way stronger than the S&P. But that doesn't mean the NASDAQ's strong. It just means, well, pretty much the banks and other stocks in the S&P have just not been doing that well, particularly the banks. IWM also has some financials, and it has meme stocks, and it's looking pretty weak now. It's sort of jumping on this level. That's been pretty important for the IWM. But yeah, still not super decisive as an indicator. Oil correlates very strongly with dollar flows. I mean, you can see the big run up in oil when you had money coming in. Now money's getting tight, and this banking, I don't know, collapse is probably too strong. But this down move in banking has pulled oil down as well here. And so that's an indicator that monetary conditions are getting tight, which is definitely happening because banks are getting bailed out. For sure that's happening. If you look at gold, it's making a little bit of a bullish move here. So you have treasuries and gold going a bit bullish. That's not super good look for the stock market. But really, if you just go look at gold, I mean, it's been since what, like 2015 or something. Gold's been on a basic, pretty, volatile, but pretty much been on a bull run since 2015. That's like 7 years or 8 years, whatever. And so it's like right back to trend here. And I don't know. I don't think that's too big of a gold, but too big of a deal. But I do think gold is just going to continue to bull here. Although it will pull down temporarily if you do get a big market crash. So heads up on that. Copper looking kind of droopy, but it's still up pretty high. Not super important indicator. Bitcoin is really interesting here because usually Bitcoin, when it breaks out of one of these wedges, goes super bullish. I mean, if you just go back and look at the last couple times, it broke out of a wedge, boom, big break to the upside, like huge break to the upside here. And so we've broken out and we started going up. Only problem on the technicals here is we're underneath this super long-term bull market line that's been support for whatever it is, like 12 years. And now we're underneath it. We're coiling underneath it. So it looks dangerous on the technicals. And also every time that we've had one of these big bull runs is a big monetary expansion. The Bitcoin runs with monetary expansion. Right now we're looking at contraction. So be careful with this one. Not monetary advice, not financial advice, as always. But I'm definitely being careful with that. And I also shorted Coinbase as soon as I saw the EuroDollar futures starting to move up. I threw a short on Coinbase and Tesla because I thought we were going to jump up to a higher interest rate level, which is not what happened. And so I'll go back, but it's still a pretty scary thing that happened. It's not what I thought was happening. It's worse. But yeah, anyway, Coinbase is coiling, and I have a short on here. Then I also threw a short on Tesla, which I think will have a lot of exposure to a contraction. Both of these are kind of like a multiplied or like exaggerated versions of a contraction, which could hit could hit Bitcoin or could hit the FANG stocks or the big tech kind of stuff. So yeah, I want to go back to the main chart here that we're talking about today, which is EuroDollar futures, and I've done one minus EuroDollar futures, which flips the chart upside down, so it matches the Fed funds rate when you flip it upside down. And so the Fed literally just follows this chart. Like, this is a forward indicator. It's everyone betting on future inflation rates, and it's a very good chart for determining what's going to happen. And then the Fed just follows behind this chart and just goes wherever it's going, basically. Although this time on the hiking cycle, they've intentionally stayed behind it, which keeps interest rates lower, which allows banks to lend more. And then you get into the situation where they have made too many risky loans, but they wanted money coming into the system because this was threatening to go to negative interest rates. And so you got stimulus checks and you got artificially low interest rates to get more money into the system. And this is the problem that you run into is bad loans and the banks get in trouble. And so we've hit that point now. So I'm very comfortable calling a top on interest rates here. It's just what does it look like on the way down is the big deal. But let me talk about the banks for a minute because there's 5 banks that have gone insolvent already. And just like the past week, there's Silvergate, which is a Bitcoin bank. What's the other one with an S? I forgot. I forgot the name of the other one. There's another bank that does a lot of Bitcoin that starts with an S that went insolvent as well. SVB, Silicone Valley Bank, does a ton of tech startups, and that's a huge area where a bunch of money went into the economy on the bottom here. and still going on the way up. There's been a bunch of money coming in from venture capital and going into Silicon Valley Bank, and so that's the big one that broke the news. But there's 5 banks. First Republic Bank is a pretty normal bank that got in trouble, and then Credit Suisse is a big one. It's a giant bank in Europe that's in Switzerland, and so they're bailing that bank out. Um, and this bailout, I mean, people are saying it's not a bailout, or it is. I mean, it's kind of a bailout, I guess. What they did is FDIC only insures to $250,000 per account, and so the Fed came in and said they're just gonna basically insure any amount in any account so that people can get their money, um, which sounds good, but yeah, it's a bailout, sort of. But they're not bailing out like the stockholders in the banks, like First Republic. I think will be the first one to get bought out. Like they're trying to sell the bank now to, I don't know who will buy it, but um, yeah, they're trying to sell the banks. So it's not a full bailout of like the CEOs or the investors or anything like that. They bailed out the FDIC, but also what they're doing is they're taking the bad treasuries off the books and giving the banks liquidity. And so that is a bailout. And that's the way that the Fed see, because let's go look at the yield curve and then I'll come back to this chart. So the yield curve is inverted right now. It's big time inverted. If you go back to other crashes, when the yield curve inverts, like if you go back to 2008, so the yield curve inverted just a little bit, goes steep. That's the financial crisis. If you go back to 2000 here, it inverted, went steep. That's the dot-com crash. So what happens with the yield curve is like interest rates are really low and the banks have to hold assets. They hold a bunch of treasuries. And so the treasuries are yielding 1% or something like that. And then you get this big run up in interest rates where the short term, uh, treasuries are yielding like 5%, but the bank's stuck holding a bunch of treasuries that are worth 1%. And so the interest rate that you can get on a checking account or a savings account is just less than 1%. But you can go put your money in treasuries now and get 5%. So people are going to take their money out of the bank, go put it in treasuries to get a yield. And then when you're taking money out of the bank is going to have to sell the treasuries that they're holding. They're upside down on these treasuries now that are only worth 1%. Like they're going to take a haircut of 20-30% or something on the treasuries trying to sell them. And so they lose money. They don't have the money to pay everyone if everyone's taking the money out. And so you run into this problem. And so what the Fed is doing is they're taking the bad treasuries off their books and the Fed's taking them. And they're giving them money which they can either pay people out with or they can buy treasuries at a better rate. But in any case, it is a bailout, and that's why the banks are getting in trouble. They're just upside down on a bunch of treasuries and the interest rates are going up, and that's hurting the banks that are holding, treasuries that are at a lower interest rate. And that's what happens at the top of a cycle. So you're hiking, this is a hiking cycle, the interest rates are going up, inflation's going up, interest rates are going up. And this big peak reversal is a big deal. So let's talk about peak reversals and let's talk about the cycles, because this is what happens to the stock market. When you're going sideways at the bottom, this is big time bullish. When you're going sideways at the top, it's weak bullish. But the big down moves are where you get the collapses. This big one here is COVID. This one here is smaller, but the 2018 crash was pretty big as well. And you can see the peak here wasn't a huge, volatile, crazy thing, but it was kind of right in the middle of the top, and then you get the 2018 crash. If we go back to the financial crisis, is a very good correlation with what's happening now, because we had the bank failures leading into the down cycle. So in the financial crisis, you run up. It wasn't quite as steep, and so we had kind of weak, kind of sideways, a little bit bullish run up to the top, right? Then you get your last little run. That's the peak of the thing. But what we had here, this peak reversal here where we go to a lower level, was the Lehman moment. And so they bailed out AIG, they bailed out Bear Stearns, but Lehman they didn't bail out. And this was the first drop in the financial crisis. And then you get a bull trap here. Boom, this is the second drop. Then you get the big bull trap and the last waterfall. And so each of these down moves correlates exactly with the big crashes in the financial crisis. And that's what happens every time in the cycle. Vertical down moves crash the market. It's a huge consolidation of dollars. Like dollars are leaving the system, it contracts. The financial system contracts, the stock market comes down. On the hiking cycle, like roughly on a hiking cycle, it's going to be kind of neutral sideways. It depends how steep it is. So our hiking cycle this time was really, really steep and really high. You can see these huge gap moves to the upside, vertical moves. Vertical moves hurt the market, and we had big. Each one of these vertical moves was a crash in this, what people are calling a bear market. I'm not calling it a bear market because it's on a hiking cycle, but it was steep enough to pull the market down, and then we stabilized and went sideways and up a little here. But now we've had the peak reversal. So let's go look at this Lehman peak reversal, and the financial crisis is here. So in the financial crisis, you had banks collapsing and going insolvent. You had the Lehman Brother moment here. And this immediately started the crash in the financial crisis. So the peak reversal can be in the middle of the top, or it can be like right at the end where it immediately crashes. So we could have 2 days until we start crashing. We could have 2 months. I mean, it could really drag out. I don't think it would be like 2 years. That's too long. But this is 2000s. This is the dot-com bust. And you can see the hiking cycle goes up, and it was only flat for a month. And then you get the peak reversal to a lower level, boom, dot-com crash. So this is towards the end. So the peak reversal tends to be towards the end of the cycle, and then it just depends where the big move down happens. And this is the crash. This is pretty steep. Dot-com crash was pretty brutal. But we also had a peak reversal here in 95, and it only came down to this level, and it held at a high inflation rate. You get a weak bull market up here, leading into the dot-com bubble. It wasn't even that weak of a bull market. The dot-com bubble was pretty big. So you don't have to like crash all the way down to zero. There was not much of a crash at all here in 95. It was just some volatility. So that's a look at what could happen now as well. And then if you come back to the 90s, we had a recession in the 90s. And so we had a peak reversal here, which was volatile, but then it stabilized for almost 2 years before you get the recession in the 90s, was this big down move here. So you can kind of just see where the recessions happen and the stock market crashes happen. Like the recession is just like the way down is a recession every time. And a big crash is going to be vertical down moves. If it's gradual, it's going to be a bear market, but not like a collapse. And so this was not a collapse. And also we're at higher interest rates back here in the 90s. It was earlier in the cycle, so it's less volatile. And then, yeah, you can see volatility here, but there aren't huge crashes. Actually, 80, when was Black Monday was somewhere in here. I can't remember exactly when it was. But yeah, there was a big crash for Black Monday here. And then this is the Paul Volcker era here in the 80s, early 80s, where our interest rates were topping out around 16 to 20%. They were way high. And that's like the interest that you can get on a treasury bond. It was like 16%, or like a house mortgage was that high where nobody could afford a loan. And then prior than that, it came from World War II, like the Great Depression in World War II, all the way up to the 80s. The interest rates were going up the whole time. And then from the 80s down to where we are now, the interest rates are falling. So you can see the trend here, like the yellow line and the blue line. And it's just doing hiking cycles, but it keeps falling, it keeps falling, it keeps falling until it gets down to the financial crisis here. And it went to zero. So interest rates sat at zero. And we had the huge bull run there after the financial crisis that went for like 10 years. Weak hiking cycle. And then we get the 2018 and the COVID crash here, and we're back to zero and actually threatening to go below zero. So that is what prompted the Fed and the Treasury to step in and the Fed is staying behind underneath the rates, right? And the Treasury came out with stimulus, so they don't want the interest rates on the dollar to go negative. So they did extra stuff to get it popped, and it worked. They got up out of the downtrend. Like the interest rates are up above the downtrend, but now we've run into the point where banks are collapsing. So that's going to be the end. That's going to be the end of the hikes here, because it's not possible to go higher with banks collapsing. It just matters on the way down. We are going to head into a recession, but we could stabilize for months and then we can go into a recession, or we can go into it immediately right now. And it just depends how steep this move is. Like if we get like a steep down move and a steep down move and like a steep down move, if we go like all the way down to zero, that's going to be like the financial crisis. That's going to be major crashes in the stock market, huge monetary contractions. It could have the threat of going negative again, or they don't want that to happen. I don't think they want to get down near zero or try to go negative again. They're trying to hold it up. So we'll have to see what kind of policies come out, but it may be gradual, and it may hold at a rate here, and we could get just a small pullback, and we could go into a bull market, like maybe a weak bull market. Just depends like what this move looks like, but this chart is a leading indicator. It does tell you what the Fed is going to do, and so the Fed right now has room to hike the 0.25 that they're talking about. There's still room for that, and then after that, I don't know. Like if this starts coming down, the Fed may be like, well, we're going to come down. But a lot of times what happens on these big crash moves is the Fed is like saying, oh, we're going to hike again. And then it comes down. And then they're like, oh, we're going to do an emergency rate cut. Like, oh, we just decided all of a sudden that we just feel like cutting it. Like, no, you don't. Like, you don't decide what happens at all. This thing came down. You got to go with it, because that's where the interest rates actually are. And the Fed does not want to be above the interest rates. So when it comes down, they come down with it, and they'll break their timing on their hikes, and they'll do an emergency cut to come down with it. On the way up, they've stayed behind it. It's okay because they want extra money coming out. But yeah, anyway, that creates the situation where bad loans are out and banks get in trouble. And so that's where we are. That's where we are. We're getting ready for a recession. And I mean, if we did this, that's bigger than a recession. That's a major crash that could go into a depression, especially if we went to negative rates. So that is possible, but we'll just have to see what it looks like. But in any case, that's what's up with the Fed in their fake little hiking announcements and their fake little pivots and whatever they're saying. But they do have policies that affect the flow of money, and keeping the Fed funds below the actual interest rates is one way to get extra money out. And the the Treasury stimmies is what really broke us out of the downtrend here. And that's what they were trying to do. But we'll have to see what happens. So yeah, happy trading. Good luck, and whatever.